So recently, Bill Ackman of Pershing Square, the hedge fund, legendary investor, he sold 10% of his company, of his hedge fund. And this is an example of a minority investment in a general partnership, but a hedge fund instead of a private equity firm, which is what we typically focus on. And I think this news is instructive for three reasons. So let's start with number one. Number one, the most common objection when people think about GP stakes investing is that, well, if the general partners of these firms want to sell a piece of their printing machine, the company that generates all this profits, that's such a good business, it must mean that there's something up, that they're not going to grow as fast, that they're really past their prime. And this is Bill Ackman, who is probably the most ambitious investor in the world, is definitely in his prime, and is still deciding to raise this money. Now, why? Well, he's publicly said that he has plans to grow his AUM substantially. He's going to be raising, it sounds like, a $25 billion fund that's geared towards retail investors, which is pretty ambitious. It's certainly not a sign of him slowing down because he's hit his peak and he's winding down and he's going to retire and go to the yacht. This is a clear example of him using that capital for strategic growth purposes that are going to benefit not only himself and his company, but of course, also the investors who are ponying up $1 billion to invest in his fund. So I think that's a pretty good sign of how this capital is used strategically for growth. Number two, I think it highlights valuations because he got a healthy one here. He sold 10% of his company for about $1 billion, which implies that his hedge fund is worth $10 billion, which is great, but he has $16 billion of assets under management. So that means they're valuing his company at about 60% his assets under management. I'm sure a ton of investment management firms would kill for that valuation. Now, I don't know exactly what it translates to in multiple on earnings, multiple on his fees. I've seen several reports where they think it's somewhere in the 30 range, which is close to maybe Blackstone at the peak of the market 6 months ago. Blackstone's trading much lower today on a multiple range, but call it peak private equity multiples is about where he's trading at, if that is in fact true. Now that could be just his management fees, which get a higher multiple than the multiple on his profits participation, his promote, than the recurring management fee stream, which is more like enterprise software. And so it's rich compared to not only public market comps, but it's extremely rich compared to private market comps in a private equity GP stakes fund. So once again, very rich. Granted, he's a celebrity. He's a legendary investor. He once in the crisis, he turned General Growth Properties from a penny stock into 31 bucks, made $1 billion and change on that investment. So he's quite good. Still a very rich valuation. I think it's useful to point that out compared to private equity general partnership multiples. This is a different type of investment, which brings up my third point here is the difference between investing in minority partnership stakes in private equity firms versus hedge funds. Now, the industry really got started investing in hedge fund ownership, in slivers of ownership in minority stakes of these giant hedge funds back in the aughts. When hedge funds were a little more popular, they were earning better returns. The S&P hadn't been on a 15-year outperformance run with the Magnificent Seven generating all these crazy beta returns that beat all the hedge funds that were charging more fees. But even then, when hedge funds were generating more performance and had more assets under management, it still wasn't a good idea to be investing in minority interests in these firms for a couple of reasons. One, the manager could just decide that he doesn't want to be a hedge fund anymore. They're very dependent on one person. The key man risk is through the roof on a hedge fund because usually, unless it's a pod shop where it's a bunch of giant teams and they make money, which is probably a good firm to invest in. If Citadel is watching and they want to sell a minority stake, please call us. But most hedge funds are generally, it's one person or a small team of investors making all of the decisions. And so if they leave the firm, well, there goes all the IP. There goes the whole business with them. They could have a week of just horrible trading, horrible decisions that blow up the fund. We saw a bunch of people do that in 2022 with the whole meme stock craze, where a bunch of hedge funds that were short those stocks completely blew up their firms. They could just decide they don't want to do it anymore. And while there would be restrictions in their documents for the minority stakes, at the end of the day, there would have to be lawsuits in order to try to get some of the money back, and it would be a big mess and be tied up in courts. We as investors wouldn't have a ton of options if that happened, if they wired all the money back to the limited partners And we're like, hey, what about all the growth you told us about? And so hedge funds just aren't a good fit for minority stake investing versus private equity firms, which are a fantastic fit because of the length of the contracts. And it's typically not just one fund. A hedge fund might only be one strategy, whereas private equity might have several strategies, different vintage years, 7-10-year hold periods, giant teams, where the IP is spread out, the talent is spread out across these multiple teams. Highly unlikely these firms are just going to quickly disappear, have a 1-year horrible existential performance run that would make fundraising near impossible in the future. Private equity firms are just a lot more stable this way. And so you're probably connecting the dots here that the future of a private equity firm is just much more inevitable. If it's been successful, it has a large team, it has multiple strategies over 5-7 years. There's just many more ways to win than a hedge fund that needs to do the same thing year in and year out. And it's just much more vulnerable by comparison. So anyways, this was a story about one of the greatest investors and why he's selling a stake of his very successful hedge fund. And I think it is instructive on the larger GP stakes world and kind of highlights some intricacies about this space and why it differs and why we love it so much versus investing in hedge funds. But all that being said, I would not bet against Bill. I'm pretty sure he's going to do quite well with this new venture, and he will use this billion-dollar investment to grow substantially. So good luck to Bill and his investors. Thanks for watching. If you'd like to get access to our GP Stakes research, go ahead and click the link below, visit our website, and we'll shoot you an email. Thanks.